Now, this is where it changes into the safeguard, right? Right now, we're talking about the wheel strategy. We believe the wheel strategy is like the wooden wheel. And then we kind of progressed into the rubber wheel. And that is what the safeguard strategy is. So you want to do the safeguard strategy correctly, but if you do it wrong, it's not going to blow up your account because you can always fall back on. Let's discuss the four strategies that make up what we call here at the Dorian Trader the safeguard strategy. Now, this we call it the safeguard strategy because it's the safest strategy out there, even safer than putting your money in your 401k and letting it sit for 20, 25, 30 years until you hit retirement, because that's just a play on the market. If you put your money in your 401k and an S&P type of mutual fund, it's just a play on the market. And if the market goes up, which it has 100% of the time over any 20-year period, not a cherry picking time, any 20-year period, it has went up. So you will make money if you do that. And so a lot of financial advisors, a lot of investment so-called experts, they preach that because historically it has been super, super safe. Buy and hold, buy and forget. The safeguard strategy here at Dorian Trader is safer than that. And it allows you to be better than average. The best you can be by buying a mutual fund is average. It's the best you can be. With the safeguard strategy, it's safer than that. And because of the simple fact that you can sell options against your shares, that's going to reduce your cost basis over time. And that's going to help you outperform in itself. But because the safeguard allows you to have unlimited upside if you're using one of the certain strategies that make it up, or allow you to limit your downside, which you cannot do in a mutual fund or any other aspect besides the collar strategy that we incorporate into the safeguard strategy. Limit your downside and still have unlimited upside using the safeguard strategy. It's powerful, but it's not a kind of sit and forget type of strategy. When we first came up with this, we called it the 1 day a month strategy, basically, to help people who just had a really busy work schedule, and they still wanted to trade, but they didn't have enough time to really focus on it. Put it on with 30 days to go, come back in 31 days, and to tell you what you need to do next. It was that simple, and it can be that simple. But if you want to use it on a weekly basis, you can, and that's what most of us here at the Dorian Trader have been doing. Manufacturing a dividend each week, what we call a synthetic or a manufactured dividend, creating your own dividend, being able to kind of forecast better because it's harder to forecast the longer you go out. You can kind of get a better picture of what's going to happen in the next 7 days than what's going to happen in the next 30 or 60 or 90 days. The safeguard strategy has a little bit more activity in it of moving the options and sometime closing out the whole trade and reestablishing a new trade. But it's simple if you follow the steps. It's not like doing a 0 DT trade. It's not like day trading. It's not like doing a 1 DT trade. It's not like doing a 7 DT trade. Those are more complex. Those have a lot more moving parts. Those can blow your account up if done wrong. You want to do the safeguard strategy correctly, but if you do it wrong, it's not going to blow up your account because you can always fall back on buy and hold. Just wait for something to come back if you're doing it on the right underlinings. And here at Dorian Trader, we believe that's indexes. Yes, there's some good companies out there that you might have an interest in, but the safest route is doing the indexes. I said this is like buy and hold. Well, the safest way to buy and hold is buy an index, an S&P 500 index. Well, if you can do that and marry it to options, which you can, a lot of you don't know that or didn't know that. Now you do. It will make it so much more effective, so much more rewarding in your P&L performance. So it's four strategies that make up the safeguard strategy. We take two that is commonly known as, or well known as, the wheel strategy. That's when you start off by selling a cash secured put, something like this. You sell the put, and it's cash secured because you have enough money to buy the shares. In this case, it'd be $8,400. You have $8,400 in your account to be able to buy the shares of this TQQ. That's a cash secured put. If it stays above the 86.5, you win. If it drops below the 86.5, but not more than the premium that you received, in this example, 256, you still win. If it drops past that, you're going to lose at that time, but you do not have to realize that loss. You can take ownership of the shares, and then you can do the second part of what is called the wheel strategy, and that is selling a covered call against the shares. It looks something like this. It's you have 100 shares, and then you sell a call against it. You rent your shares out. Some of you have heard me call it the landlord strategy. In this case, you have 100 shares, and if you rented it out at the 91 strike, someone would pay you about $415 for that strike. That's premium coming into your account that you never have to give back. That's that manufactured dividend. That's that synthetic dividend. That is your dividend that you created yourself. And if it jumps up, you'll still have upside potential with this covered call. You can make as much as 565. Just want to take a quick second and say if you're interested in learning more, please consider joining our trading club. You can do so for a 90-day trial period for a flat $60. Check out the description below. Now back to the video. But with that put, as you probably noticed, you had risk all the way to zero. Well, with this covered call, you also have risk all the way to zero. Doesn't mean it's going to go to zero. This is an index. It's a leverage index that we demonstrated on right now, but it's still an index that has outperformed the index that it's following, the QQQ. It's outperformed it over the last 5, 10 years. It's destroyed it. So this is safe, especially using the safeguard strategy. Are you going to be down sometime? Unrealized losses? Absolutely. But you do not have to realize them because this is like buy and hold, but better. Now, this is where it changes into the safeguard. Right now, we were talking about the wheel strategy. We believe the wheel strategy is like the wooden wheel. And then we kind of progressed into the rubber wheel. And that is what the safeguard strategy is. So, for example, with the safeguard strategy, you can take some of these monies from the call that you sold, which is about 415, as you can see down here, and you can buy a put. And if you buy that put, before I click on the put, I want you to see the max loss here. The max loss, when you're just doing the cover call or the cash secured put, it's all the way to zero. So right here it's saying a little over 8,500. If I buy this put for something less than what I received for the call, and let's say we just buy this put here at the 84.5, well, that max loss went from $8,500 to just over $300 because of that put. No one else out there is preaching this collar. You can test me on it by going to YouTube and typing it in. No one else is preaching this collar because they're charlatans or they really don't know about it. Maybe I shouldn't call them charlatans. And so in this case, with this collar, it's protecting you to the downside. So if the S&P 500 or the NASDAQ 100 or the index drops a ton, you're only going to experience a small fraction of that loss because you have that put. And so if the index drops 20% and you only drop 10%, well, you have a significantly smaller amount to recover. So when the market recovers, which it does 100% of the time, you're going to outperform because you're already outperformed to the downside. This is how you be better than average. Understanding how to structure trades to protect yourself the best. And so, as a Dorian Trader member, we've been preaching this collar a lot, especially as this market continues to go up. Today, the market is down, as you can see, but this is a fraudulent down day as much as we've been up over the last 3 months. Over about 35, 37% in 3 months off the April lows. This is fraudulent. This is not a down day. This is a pause. The market is taking a breather. It's getting a water break. This collar is powerful because when we have that drop, because we have a 10% drop every single year, primarily, at least, which is considered a correction, this is going to help you significantly. And you prepare yourself accordingly. When the market is going up a ton, you don't continue to try to get unlimited upside. Yeah, you still want to make money as it goes up, but you prepare yourself for the fall. This is the third strategy of the safeguard. The fourth strategy is what we call the bionic bull. This strategy differentiates itself from the wheel strategy as well because the wheel strategy, you don't have unlimited, but you have risk all the way to zero and you never have unlimited upside. It's always capped with the wheel strategy. That's why we call it the wooden wheel. Well, the safeguard strategy can limit your downside with that collar we just went over and it can give you unlimited upside with this bionic bull. So the bionic bull is taking that cash secured put, and say we sold this put at the 87. You're taking some of those monies, which is about $365 that you're receiving, and you buy a call. So if we did this, we would still get $70 of credit, right? We still get a $70 credit, but you can see here the max profit is unlimited. Yes, we still have risk to zero, but if this stock jumps up, this index jumps up a lot, especially after dropping a lot, let's say that it's dropped 5%, it's dropped 7%, it's dropped 10%, it's dropped 20%, like it did in April. This is the time you deploy something like this. The market always comes back. I can't stress that more. Sometimes it comes back really fast, like it did this time. Sometimes it takes a little slower. But this is a way to eat as the market goes up. Just gain a lot as it goes up. The bionic bull, selling a put, taking some of the monies to buy a call. The basis of options. If you buy a call, you're bullish and you have unlimited upside within that time frame of that call. This is how you structure things to benefit you. You don't always do the bionic bull. You don't always sell a cash secured put. You don't always sell a covered call. You don't always do a collar strategy. You do it based on the situation at that time. And the more you learn this, the more you'll understand the situation. Right now, we've been going up a ton. We hit all-time highs. We hit a new high, I think, almost every day last week. That should be alarm bells. Not that we're going to fall a ton. That's possible. Not that we're not going to keep going up. That's possible. But the odds change and they start leaning more to the downside, that the bigger move, the bigger pot odds, as it's said, it's greater to the downside once you start to go up too much, once it starts to get into that ridiculous mode and you hear everyone talking about making money, everyone talking about how bullish the market is, everyone's starting to get FOMO. Be vigilant.